Andrew Nicol, Ed McKnight, how are you?
So good. Thanks for having us here, Darcy.
Hey, thanks for coming. Thanks for flying up, especially just to see me. So tell us a little bit about who Opus Partners is just before we get started.
So we are property investment coaches, I guess, and what we do is we show people how you can use property to achieve your financial goals. So be it retirement early or passive income in the future or sending your kids to college, whatever it is that you want to do, we do it through property. And we've got a whole infrastructure around making sure that you select the best possible property to get you there.
First-time investors, presumably, or people that are expanding their portfolio? Like, who's your typical client?
So we kind of have a mix. So a lot of clients that come to us are brand new to investing, and so they want to figure out where they're at. So they might be 40 years old, 45 years old, halfway through their work career, don't have a lot in KiwiSaver, and they might be thinking, holy hell, how am I ever going to retire? How am I going to pay off my mortgage? And so what we'll do is we'll build what we call a wealth plan. And so we've got software that we built to do that. And we just released our book, Wealth Plan, which was on the premise of using property to fill your wealth gap. So it works out, okay, if you're 45 and you want to retire at 65 and you keep doing what you're doing right now, you'll have $23,000 a year to live on. Do you like the idea of that? No, not really. Okay, so how are we going to bridge that gap between where you're going and where you want to be? And then we'll map out property purchases over a number of years, and then we'll implement that plan.
Got it. Now, separate to this, well, not really separate, I guess it's kind of all intertwined, is the podcast. And we were talking before we hit record around the fact that I had you on the show maybe like 5 years ago. That was probably I'm guessing that was your first podcast.
My first podcast ever was your podcast. And I had quite a lot of inquiry after that, people wanting me to look at their portfolio. I helped them grow a portfolio. And when Ed joined the team, he said, that was very effective. You should get on more podcasts. And then he tried to get me onto a competitor's podcast. That competitor told him to bugger off. And then he said, fine, we'll start our own. And 1,300 episodes later, here we are.
That's awesome.
Yeah, so it's called the Property Academy Podcast, and that's a daily show, 10 to 15 minutes long. Yeah. And so far, 1,300 episodes covering everything about property investment.
And every Sunday, I get a panicked phone call from Ed, and he says, "We've done it. We've done every possible topic on property. We're going to have to end this." And then I talk him down off the ledge, and then a few hours later, I receive 6 new briefing sheets in my inbox and a case study, and then we record.
You have heard of ChatGPT-4 though, right?
Well, I actually, Ed's the tech guru in the office, but I did find the chat GPT and told him about it.
I already knew about it before.
You always say that.
He loves to claim that I'm Andrew Nicol and I know things.
Anyway, so now he's actually using it to come up with his podcast titles.
Yeah, so we're recording a podcast about whatever it happens to be, and I'm like, how are we going to sex up channel valuations? So ChatGPT-4, you're a YouTuber, Darcy. You'd know Mr. Beast, who's the number one YouTuber.
Yeah.
So, hey, ChatGPT, I'm recording a podcast about channel valuations. Write me 10 different podcast titles in the style of Mr. Beast. And you'll get back insane. Property investor saves thousands through chattel valuation, or property investor pays less tax using this one simple hack, and it's so using a chattel valuation.
They are quite good titles. His titles have seriously increased.
So that's the secret sauce, right? Is how you prompt it, right?
Yes.
So if you wanted to do like a version of Dave Ramsey, for example.
Dave Ramsey, people like to call me.
That's right, Gave. So if Dave Ramsey was saying a certain title, you could do that, right? It's all about the prompts. And that's what's so cool about it, is that it's kind of democratizing the creative space, and it's bringing it more accessible. Like, my thumbnails are going to change now because you've just given me a great idea. But that's how it works, right? Mm-hmm. It's like the democratization of the ideas and the things that can help people kind of get an audience, which is so cool because you guys have built a business off of that, or you've bolted it onto a business to effectively supercharge it. How do you think about it?
I think the business has changed quite a lot because our whole ethos is to tell people everything. They can decide if they want to use us, but we're going to tell you how to invest in property successfully, and then you can make your own mind up whether or not you want to delve into that yourself or whether or not you want to use professionals. And it's quite a scary marketing direction because you always feel like you've got secret sauce. And if you give away the recipe, why would someone use you? And so Ed basically berated me until I tried it, and it is probably the best thing we've ever done because the truth is there is no secret sauce. Investing in property has been around forever, and you can go to the library and you can get a book. The secret sauce is in doing it. So if we show people how to do it and they realize, actually, this isn't as terrifying as I thought, then they're going to be more brave. And look, some people are going to do it themselves. That's okay as well.
So I want to talk to you about the property market in particular. So the new build property investment space is kind of that's ultimately your bread and butter, right?
Correct.
And so I often look at that as one of the options. Obviously, that's the main option that you're selling. And like you said, Andrew, you're going to put the information out there and help people choose. But really, it's going to be coaching people if they're buying new build properties, right?
Correct.
That's ultimately the business model.
We
right?
we do actually have a service for people who are active investors. So there's passive investors who want to buy a new build and hold on to it, and then there's active investors who want to buy a property and renovate it. Now they're the only two strategies that work in property investment now with the new tax regime. So if you're going to buy an existing house and rent it out, it is horribly inefficient unless you increase the rent and increase the value. So you do that through an active strategy. So we have Opus Accelerate for those people that want to actually do that as their property investment mechanism.
But similarly, we help investors with all sorts of different strategies because we've got a mortgage broking business, we do insurance, we do property management. We've kind of got something for everybody because we want to help property investors be successful. We're very proud owners now of the New Zealand Property Investor magazine. And so we help all of the members of the New Zealand Property Investors Federation because that's part of their membership for a lot of them. So however somebody wants to grow their wealth through property, we want to be there to help them. And we like to have a service so we can be able to do that.
That's awesome. So a lot of people have been commenting around market pullback. It's been pretty obvious, I think, from probably a couple of years ago, as soon as there was the first hint of interest rate rises, that this was going to happen. But knowing it and preparing for it and adjusting your thinking before it happens, those are very different things. And I want to know, like, how we should be thinking. So if you're an existing investor versus a new investor, how do we think differently, knowing that there's a pullback coming or we're in a market decline?
So I think for existing investors right now, the biggest and the best thing you can do is review your properties and figure out if they're the ones that are going to take you to the next stage of your wealth creation. So for a lot of properties, they are becoming more and more inefficient with the tax regulation, with the interest deductibility phase out. So I'll give you an example. I met with some people last Friday. They came into my office and they've got a reasonable portfolio, I think about 9 rental properties. And I asked him, how much do you contribute towards those rental properties now? And he said, we think it's about $80,000 a year.
Yep. So those properties, they're having to top up the mortgages by about 80 grand from their own incomes.
Yep. And they earn 400,000 net as a couple, so good incomes. That's reasonably comfortable. Now, I put it into my spreadsheet. Turns out they were wrong. Their actual contributions next year on their current interest rates are going to be $360,000 by the time they pay tax. So they're making a loss and then they pay tax. So they're insolvent. So the best thing that existing investors can do is figure out, am I going to be able to afford these properties with the new tax regulation? If you can't, you need to take some action now, because the last thing you want to do is think, you know what, National will get in and they'll repeal this. Look, you've got a 50-50 chance of that happening and then a 50-50 chance maybe of them repealing it. So you've got a 1 in 4 chance that that's going to happen. So I think it's, in my opinion.
Honestly, you pull out these numbers like, oh, it's a 50% chance of this and 50% chance. That's like, we were somewhere the other day and Andrew said, 50% of developers are going to go broke in the next 12 months.
I did say that.
And then you got head up about it. I'm like, you just made that up.
Well,
And then you said,
do you know
no,
that 98% of statistics are lies?
I've got the talkie stick, thank you, Andrew Nicol. And then he revised it down to 20%. Now, just to get into what he's talking about here in terms of this new tax rule, for any listeners of the show who perhaps aren't aware of the new interest deductibility rules, effectively what these mean, and these were introduced back in 2021 by Jacinda Ardern and Grant Robertson, effectively you will be taxed as if you don't have a mortgage, despite the fact that you still have a mortgage to pay. So if you think about your rental property, if you own one, or even if you don't, just imagine it. Oh, doesn't that sound nice? You should go to Opus Partners. So,
Ed, you're always selling, man. This is great.
So you've got your rental property. Imagine how much you'd be making if you didn't have a mortgage. Gosh, well, yeah, I'd get my rent, I'd pay some rates and insurance, but I'd have a lot of money left over. Great. So you'd be paying quite a bit of tax because your rental property is really profitable. So imagine paying that same amount of tax, and now you've got to pay your whole mortgage because it hasn't gone away. So that's where you could be making a loss on your rental property, perhaps $10,000, $15,000, but you might still have to pay tax as if you're making $10,000 or $15,000. And so not only are you losing money, you're having to pay an additional perhaps $5,000 or $6,000 in tax on top of that.
And how do you feel about that?
It's ludicrous. Overnight, the government made a bunch of insolvent business owners, and I don't think it's fair because property is like any other business, and we have a rental crisis, and it's going to get much, much worse. You've got 35,000 families on the wait list for emergency housing. We need private landlords, and if you do everything to discourage them, they'll exit the market. They'll put their money in something else. So I think it's a real problem, and it's going to get much, much worse. And I don't think people realise how bad it is yet because the phase out's only we just ticked over the second year.
Yeah, we're like halfway through.
Halfway through.
Right? And then that in combination with a falling property market because of higher interest rates, tougher lending restrictions, general recession, inflation. Do you feel like a lot of investors or just everyday people are kind of flying blind, have their heads in the sand?
Absolutely. I think that's a big thing that people are unaware. Like this guy this guy that I was talking about before, he uses a very reputable property tax accountant. And he hasn't even had a conversation with his accountant. He hasn't filed his tax returns for the last 2 years because he's been so worried about it. Now, next year, he will get this 80 grand bill and he won't have the money to pay it. So if he doesn't sell properties now, the IRD will sell them for him.
Which is scary.
Very scary.
Coming back to your question about sentiment, though, I think there are two groups of people. We get to work with quite educated property investors because if you've listened to 1,300 episodes of us yabbering on about property,
you're going to be educated.
You're going to understand it. So sometimes there's a bit of I want to call it bias in our sample because a lot of the investors, even in this case, this person would have been very educated about property investment in general. And so if you're talking about sentiment, a lot of the people that we get to talk to are quite positive about the property market at the moment. They think interest rates are either at or very near their peak. They expect them to come down over the next couple of years as inflation starts to get tackled. They see that house prices in Auckland are 22% down from their peak. And in Lower Hutt, 28% down from their peak. And if you look at the most recent data, over the last 3 months, Lower Hutt actually had a 1% increase in house prices. And so we're starting to see signs that the market could be turning. So the educated property investors are often thinking, I think there's a bit of a buying opportunity here. Let's buy when interest rates are high because that's going to be counter-cyclical investing. Nobody else is investing, so we're going to take advantage now while the prices are cheap. But there is a difference between those sorts of investors and then what I would call the stuff readers. People who are on stuff.co.nz and reading that everything's going to hell in a handbasket, New Zealand economy's in recession, the economy's on the skids, interest rates are high and are only going to go higher, and house prices are never going to stop falling, and everything's bad.
Yeah.
Because, of course, that's what gets clicks, and that's what people are going to remember. And so I kind of think that there's this negative sentiment out there in the general population, and then people who are engaged in the investment community, and I imagine that's many people who listen to your show and subscribe to your YouTube channel, are probably a bit more positive because they say everybody else is really negative. Sounds like a buying opportunity to me.
Well, tricky question then. Well, yourself included, so it'll be a little bit close to home then. Do you think there's a possibility it could be a bull trap in light of the fact that there's two options here? Interest rates could reverse and maybe everybody is right, but let's look at both sides of the coin. Maybe this is a new regime. Maybe interest rates maybe this is the new low.
I think that at the end of the day, time heals all with property. And even if I get 3% capital growth of my townhouse that I just bought in Auckland, that's still better than my money in the bank. So I'm of the opinion that it's always worked for me, and so I stay the course, and I don't overthink it. Anything to add there?
No, I think that's fair enough. I mean, you're never really going to know about what's going to happen in the immediate future. And look, maybe property prices could fall another 10%, I don't know. That's not what any of the banks are predicting. Most of them are somewhere between, depending on which data you look at, 4 and up to around 8% in terms of price falls.
Yeah.
Some will say more, some will say less. But it depends what your time horizon is. I think over 20 years, or I always think about what's going to happen when I'm 65. I'm currently 30 at the moment. Do I think over the next 35 years that property prices are going to go up in New Zealand? Absolutely. I think they're going to go up, then I think they're going to go down, then they're going to go up, then they're going to go down, and it'll probably happen 3 or 4 times before I get to 65. But if you've got that really long-term outlook, and I think long-term is 10 years plus, 15 years plus, then so what if property prices fall another 10, 20 grand from the time you sign a contract? In the end, you're not going to be thinking about, oh, I really wish I bought that property 6 months later because that would have made all the difference. What made the difference is you held it for 15 years and it doubled in value.
We actually did a really good podcast
I watched that
a couple of
last
weeks ago.
night.
Oh, the one about the waiting 6 months.
Yeah. Why does everyone say, let's wait for 6 months and then we'll reconsider it, right? They never do.
Every now and then Ed just has this stroke of genius. This was one of them. Actually,
Every now and then.
It was one of the other team, wasn't it?
Yeah, one of the teams suggested it to me. So what I'd done a couple of years ago, maybe a year ago, was I looked at over a 5-year period, how often did people make money? Or was it might have been a 1-year period I think I looked at, which is over any given 1-year period over the last 31 years that we've got good data on, how many times did property investors make money over that first year of home ownership, or of owning an investment property? Did the property market go up or did the property market go down? And then one of the teams said, well, you should do it over 6 months, because many investors and people listening to the show will think, I'm not going to invest now. I'm going to wait 6 months just to see what happens, just to see what interest rates do or what the market's going to do. And so I ran the numbers across all of New Zealand and said, well, if over any given 6 month period, what was the likelihood you made money or lost money? Did the market go up or did it go down over a 6 month period? And what we found is, if you look at the New Zealand average, and maybe we can discuss more about whether that's a good measure or not in a second, but it works out to be a roll of the dice. If you roll a dice, you've got about a 1 in 6 chance of losing money, and you've got a 5 in 6 chance of gaining money. Now, of course, investing in property is not gambling. It doesn't work exactly that way, but I'm just trying to make the numbers really simple for people. So if you think you roll the dice, if you roll a 1, 2, 3, 4, 5, you made money in property.
Technically, we're talking about a die.
Yeah.
Yeah,
Oh,
correct.
Die.
Oh, yeah.
I think you made that mistake in the video as well.
Oh, he did, and I called him out on it.
I'm making a very
Roller.
important point about investment here. If you rolled a 6, you lost money.
Oh.
So I'm just trying to put it into context for people in terms of the New Zealand market average there.
Because I hear that pretty much all the time, and it's not just with property. It's with virtually any big decision when it comes to money. Let's just wait 6 months and see what happens. And that is, it's interesting because it's not like, and you don't want to you want to identify a problem but not aggravate it, right?
Yes.
And that is a problem, that we
Yes.
kind of defer our decision making. Pick 6 months, pick your time frame, but that's a symptom of something else, isn't it?
Correct. It's just being uncertain, because you really, if you're going to wait 6 months, you need to know what is going to happen in that 6 months that's going to make you make a decision or help you make a decision. Otherwise, you're just procrastinating.
Well, the cost of using that phrase, I want to wait 6 months, is not that you miss out on 6 months and on average the property market goes up by about 3.5% over that 6 months. That's not the cost. The cost is that you don't wait 6 months, you wait 6 years and end up not investing at all.
Yes.
Because if you miss out on 6 years of capital growth, whether you're investing in a fund, shares, property, pick your asset class, you are highly likely to make money over that period. And so if you wait 6 years and procrastinate, then you will have missed out on a significant number of gains. One of the other issues specifically in property is that over 6 years, the bank may change its lending criteria and you may no longer be able to invest.
And that's one of the big things with the debt to income ratios coming out next year. So potentially people are going to be able to borrow less money to buy investment properties or an owner-occupied property. So waiting has a real cost if all of a sudden you're not in a position where you can actually invest anymore, or you have to invest in a lower quality property or a worse region.
Now, just to clarify what Andrew said, he said that debt-to-income ratios were going to come in next year. I just want to correct the technicality around there. So the Reserve Bank has given themselves permission, they've given themselves the power to introduce a debt-to-income ratio at any time. The earliest they're going to be able to do that, though, is March next year, because the banks need time to update their IT systems. So from March next year onwards, there is going to be an additional restriction on your ability to borrow for existing properties or your own home. If you're investing in new builds, it won't impact you.
Interesting. So it's another one of those complicated rules where they carve out new builds because they don't want to be seen to be exacerbating a pre-existing problem, which is a housing shortage, right?
Yeah, they have to. We need more houses in New Zealand. And with net migration up, it's only going to get worse. And so there's pressure on rents at the moment, but I predict it's going to get much, much worse over the next 12 months.
50% worse?
I'd say...
Well, there's a 50% chance that it's going to get 50% worse, so there's a 25% chance.
Yeah, so I do think that we're going to see a lot in the media over the next 12 months about the rental crisis, and landlords will get a bad name again because we'll be increasing our rents. But look, it is a flow-on effect of all the changes that the government have made. Healthy homes, making it more expensive to maintain a property, tighter regulation, higher interest rates, the interest deductibility phase out. All of this costs money, and property is a business.
Yeah, just on the healthy homes thing, there's some real unintended consequences there. It's not just that it costs you $5,000 or $10,000 to upgrade your home. I saw a really interesting post on social media from an investor who said, I've got a house and it's not healthy homes compliant. I am not legally able to rent this house out, but it's empty because I had it as an investment property. Now, I'm just going to wait and I'm going to sell that property when the market recovers. But I'm just going to leave it empty at the moment because I don't want to fork out the money to make it healthy homes compliant. He had a chap knock on his door and said, I really want to rent that house because I'm struggling to find a rental. He says, I can't rent it to you because it's not healthy homes compliant. Well, I don't care. I won't tell anyone. Well, no, I can't rent it to you because as soon as I do, you can go to the tenancy tribunal and I could get fined $4,000 because it's not healthy homes compliant. But I don't care about that. I can't rent it to you. And so it's quite interesting where now I see some articles talking about ghost houses, which are houses that are unoccupied. Some of those, not all of them, but some of them will be because people have purchased them. They were investment properties. Now they're empty because the landlord, for whatever reason, doesn't want to make it healthy homes compliant and spend the money. And that's for their own reasons. It's their own property. They can do that. They're complying with the law. But that's where you sometimes have these unintended consequences.
Yeah. We see it everywhere, right? Like a little bit of regulation is really good, really smart regulation delivered gradually over time and then tested and modified over time. A lot of regulation slammed in one area all at once without a lot of thought or testing or feedback. That's where you get these, it's almost like all these unintended consequences resonate.
Yes.
And it ends up punishing the tenant ultimately because they're
Absolutely.
forced to pay more rent. And then we get the blame as property investors because we're greedy and effectively we're paying for the policies that are, yeah, they're good for people, but there's a balance here.
Well,
isn't
not
there?
always. I'll give you another one if I can. Sorry to cut you off, Andrew. So if you think about the interest deductibility rules, which is where your taxes if you don't have a mortgage, but you do have a mortgage, there is an exemption or carve-out where if you take, for example, a 5-bedroom property and convert it into two-bedroom units, for example, and they're legally consented different dwellings, then you are able to class them as new builds and you get to stick with the old tax regime. So great exemption because you're making more dwellings. But what's the unintended consequence? Well, if you've got a large family in, for example, South Auckland, and maybe there's 6 people or 7 people living in that property, well, if they get kicked out because the landlord says the only way for me to keep this property is if I turn it into 2 legally consented dwellings, well, there is now no longer a 5-bedroom property available. There might be 2 2-bedroom properties available, but how is that family going to live in a 2-bedroom house? That will lead to overcrowding and a lower supply of family-sized homes in areas where sometimes they are needed.
Anarchist in me would say just burn the government down. The libertarian would say
it's because you're Canadian and you guys are aggressive. Yeah,
it's the beaver. No, it's the beaver in me that just, I don't know, makes me aggressive. But the libertarian would say, hey, we need far less government involvement. But I kind of have to take a balanced view and see both sides of the coin with all this sort of stuff. What is the solution?
Well, I think if the government could solve the housing crisis, then
You think they can, though?
No, I don't think they could. But if they could, then maybe they could have all this regulation. But because they can't, they need private landlords to provide stock that they can't provide. And so I do think they need to take a bit more of a balanced approach to some of the rules, because they are quite harsh and landlords do get a pretty hard name. Like, I will top up probably some of the new properties that I've bought recently with higher interest rates. I might top up $300, $400, $500 a week. The rent might only be $600 a week. So I'm contributing a big chunk towards funding that property. Now, I see the big picture, but there's a lot of investors that will say, you know what? I'm just not going to do it. I can't be bothered with the hassle, and I'm not prepared to invest that money if the government keeps putting in these policies that might mean that my capital growth is not as much as what it was in the past. And that's a real problem.
Well, we need incentive, right? Like, we're not going to take risk and fork out all this money if there's possibility that the rules will change or else we don't get the reward.
And
right?
I also think that the people that are most affected by some of these rules are the mum and dad investors that might have 1 or 2 or 3 rental properties. They're the ones that are trying to use property so that they don't have to rely on the government when they're in retirement. So I think that should be encouraged in New Zealand, because we need people to be self-sufficient.
Absolutely. Speaking my language. It's good. Well, let's now maybe turn our attention to the foundations, because it's something that I've been considering probably towards the end of last year. I've been mindful of rising interest rates coming up. I've been mindful of inflation, and then I've kind of just been thinking a lot more about personal finance, going back to the basics, right? Like, what actually underpins the ability for us to invest. With the investors that you're working with, and in my mind, I kind of look at them as, say, pre-existing investors that are already building their portfolio or maintaining it, and those that are just trying to get in for the first time. Mm-hmm. What do you find are the foundational pillars that most people lack? Is it like short-termism? They're not thinking long-term? They don't have a plan? Like, what's the common denominator or the weakness in their foundations?
I actually think for most people, it's actually just kind of knowing what they need to do, how many properties they need to have to achieve their goals, because owning a rental property is pretty bloody boring. Someone else lives in it, and you have very little to do with it, other than maybe making a top up for the first number of years. So I think you really have to have a plan and go, you know what, for the next 6 years, I'm going to buy a couple of rental properties, and I'm going to have to fork out some money, but that's because in 20 years' time, I'm going to have a couple of $1 million worth of equity, for example. And so I think for most people, you've got to really have a plan to begin with, but then you also have to have enough knowledge that you're not going into it blind and just buying a property because your mate did and it went really well for him.
I think one of the other things where people go wrong in investing, and I'm talking about regular people out there, the stuff readers, that almost sounds disparaging. Now, of course, there's nothing.
We love stuff readers, don't we?
There's nothing too wrong with
They'll
reading
write
stuff.
an article about you this afternoon when this goes live.
But what I often see people do is they buy a property ad hoc, almost by accident sometimes. I was driving down the street and I saw a property on the same street I live in, and that's for sale, and my property's gone up in value, so I should buy the one down the road. Whether or not that property is a good investment, it's they're seeing properties that are available just through their own lived experience, and then decide to buy that. I was on holiday and I saw that there was a property, and I thought Taupō was a lovely place to go.
I was going to choose that as an error.
And so I decided that I'll buy there because maybe I could turn it into a holiday home, or maybe I might like to retire there one day.
You know how common that is in terms of after long holidays? I get for Monday and Tuesday after a long weekend. That's exactly my day, is talking to people about. And then it's not that it's necessarily bad, but I know where you're going.
But it's not an investment.
The issue is that you haven't gone through a process to select the right investment.
It's happening to you rather than you actively executing.
So we would always suggest you take a much more strategic approach to how do you identify the best investment. Now, look, if you want a holiday home, if you want to live a comfortable retirement, those are wonderful things. But the way you achieve that is to grow your wealth so that you can buy your holiday home, so that you can live in a nice area when you retire. But you you should never conflate those two things. Oh, I'm going to buy that, and then I've got some other personal aspiration that I want to use that property for something else, because what that leads to is a bad investment decision. Which areas are overvalued, which areas are undervalued? If it's undervalued, then there's a bit of a buying opportunity in that region. Once you identify the region and the city you want to invest in, you map out which areas are highest capital growth and which ones are highest yielding. You compare those to try and find a high growth, high yielding area as much as possible. Then you start to look for what are the developments in that area. You evaluate which developers you want to purchase from if you're going for new builds. You identify, you run a cash flow analysis on the different properties you want to purchase and say which one gives me the highest return. So there's a very structured process in our minds about how you go about finding an investment property, and whether you use us or whether you do it yourself, it's the same process you should go through. But the issue we see is that people purchase properties accidentally because they're living their lives, they see a property for sale and they think that's a good idea, and sometimes it'll work out but sometimes it doesn't, and that the properties end up being much lower yielding than they should be, and they end up being a worse investment than you could have otherwise made.
And I've speculated for a while now, and I've been wrong for so long that it's almost a joke around this, but especially holiday home destinations in particular, because they're most really a function of what's happening in the big city centers, right? Like they're derivatives of the, say, big city center property markets. I've been speculating for a while that those are probably the riskiest ones to buy in, like accidentally property investor in Taupo, for example.
Well, I think a lot of people who bought in Queenstown because it's an amazing place to visit probably had egg on their face when COVID hit. And we said, you know what, it's overvalued, it's not a good place to invest. But also a lot of people have made a lot of money in Queenstown as well.
Even in the last couple of years.
Absolutely.
Yeah.
In the last 12 months, it's gone off like a frog in a sock. And I was
Not in the last 12 months.
All right. Well, yeah.
50%
well,
chance.
still pretty good.
And let me discuss Queenstown specifically. There are a lot of people
Thanks.
who are looking at Queenstown prices right now and are like, well, maybe there's something special about Queenstown because prices are only down 2% compared to their market peak. Now, the reason that Queenstown prices haven't come down that much is that they didn't go up that much during the COVID pandemic. So if you look at a place like Christchurch, if you compare pre-pandemic prices in Christchurch compared to their peak, property prices went up just under 50%. In a 2.5 year period. It's outrageous. Queenstown went up by 35%. So if you look at Christchurch, well, the reason Christchurch property prices have come back by about 10% is they went up by a whole heap, so they had further to fall. Queenstown property prices haven't fallen that much, but that's because they didn't go up as much. If you compare pre-pandemic prices, Christchurch City has actually been a better investment and property prices have grown faster than in Queenstown. But that's the sort of approach that I'm trying to get people listening to this show to follow, where you take a more analytical approach to property investment. You don't just read an article that says, oh, Queenstown hasn't actually fallen by that much. Well, why didn't it fall? Well, because it didn't go up that much. Perhaps that suggests that Queenstown isn't as good of an investment as you perhaps think.
It's good. It's a good way to look at things. But what you're effectively saying is, in terms of the risk to our foundations around the assumptions around our behavior, it starts with the lack of planning, maybe a lack of differentiation between the financial and lifestyle goals that you're trying to optimize for. And then what you're saying is maybe there's a lack of not digging a little bit deeper and understanding the data behind why things are the way they are, right?
Yeah. We often say that property investment is more about the investment than the property. So if you think about how most people go shopping for an investment property, they go to Trade Me and they start looking for properties. They'll go to realestate.co.nz and they might know, roughly, oh, my mate owns a property here, or I hear that properties are cheap in the West Coast. Let me look at properties. And you start by analysing the property. No, you start by analysing the investment. And I think that's probably the same with shares. I'm not sure how you approach it, but if I was investing in a specific share, I would not start looking at companies. I would say, what are the industries and what are the markets that I believe are attractive? Let me find companies that I think are well positioned within that market. And it's the same with property. You find the right market, then you look for the properties within the market that you think has got good legs.
Right? It's macro first, then micro. And it's, if you were to look into the future, say 12, 24 months, what are we seeing within the property market? So within the environment where all these properties are contained, what do we see?
So it's harder to predict what's going to happen in the next 12 months than it is in the next 10 years. But where I'm focusing at the moment is Auckland, because I think Auckland will recover fastest and first. I think overall you're going to see a lot of pressure on rents over the next wee while. So that's why I'm buying things that maybe are 12 months out from completion, so that maybe I might see a softening in interest rates, I might see a rise in rents, and so the contributions will be a lot better by the time I come to completion.
Okay, so you're kind of looking at those factors that, hey, the first to enter in is the first to get out, plus it's a big city centre, it's going to be the recipient.
It's because it's Auckland. So when you think about negative net migration, people leave from everywhere. But when you think about positive net migration, most people end up here in Auckland.
That's right.
So one of the other areas that we're quite hot on is still Canterbury. We still see that Christchurch City is about 13% undervalued. If I look into the future, though, about specifically house prices, I think that we're going to see Wellington bottom out first. And the reason is that Wellington was so hot in terms of property prices. They went up by so much over the 6 years prior to the market peaking in November 2021 that things have just fizzled out now. Property prices, lower Hutt down, as I said before, 28%. Upper Hutt, I think it's about 23%. They've just fallen by such a magnitude that I think we are seeing the bottom starting to come through in those areas. Now, there is a difference, though, in what I believe will happen in Auckland and what I believe will happen in Wellington. I think because Wellington had boomed but for so much, even before we got into COVID, we are likely to see a sustained stagnation in property prices in the Wellington region, simply because they went up by such a degree. They've dropped quite a bit, but I don't think we're going to see a bounce back very, very quickly. If I compare that to Auckland prices, for instance, they were flat for 4 years before the COVID-19 pandemic. They did go off and start heating up, and now they've come back by 22%. But if I compare, say, the 2016 price in Auckland compared to today, it hasn't gone as up by as much as Wellington. Wellington prices are still well above their 2016 level, and the reason is because they were going up for 4 years before we hit COVID-19. So even though Wellington prices have dropped back by a larger amount now, there's still more ability or capacity for house prices to grow in Auckland, in my view.
Okay, that's really good. Thank you.
Everything's about what happened beforehand in investing. So, you can say, I'm trying to put it in share terms, but I don't follow the share market nearly as closely as I probably ought to. You can't just look at, well, what's happened over the last year? Have property prices gone up or have they gone down? You've always got to think, well, what's happened prior to that, so we've got more context. If you're sitting in a sauna and it's 60 degrees and you turn it down by 2 degrees, yep, it's dropped in temperature, but it's still really hot. If you're sitting there and it's 20 degrees and you turn it up by 2 degrees, it's still relatively cool. So you don't want to look at near-term price changes. You want to look at the overarching context. I'm not sure if that was a good analogy or not.
No, you're talking about percentage improvement or deterioration rather than the nominal number, right? So, like, putting all the data aside, though, because that's what
Why?
He just storms off again.
That's right. You guys are awesome at the data, by the way. And if anyone hasn't discovered the podcast yet, discover it, because if there are data-driven people, often they need more data to get comfortable with stuff before they move ahead. I guess the risk with that is that they kind of get analysis paralysis and they don't move forward. But putting aside all the data, all the logic, all the things that people should do but they don't, and actually talk about what people actually do, the behavioral stuff, the sentiment stuff, how people are feeling, are you finding that it's very difficult for existing investors to keep building during this time, not because of what they can't do, but because they don't want to? And are you finding newer investors are reluctant to take the first step?
I'm actually finding that the people that we're dealing with right now are very keen to start investing, and I think that's because the new normal is it's hard. Interest rates are high. There's regulation. It's tough to get lending from banks. But if you can get the money, a lot of the people that we're dealing with, they're very enthusiastic about investing. Now, I'm not saying that the market's all good and there's lots of inquiry. There is less inquiry right now. But the people that we are dealing with are relatively bullish. One of my investors who is just coming up for settlement on a property which has dropped in value. Okay, so they've bought at the peak of the market in Auckland. It's come up for completion. It's down about 40 grand. They are today
Not that bad, actually.
no, they today are signing up on 2 more properties because dollar cost averaging. They want to get in now while the market's down.
There's a bit of sample bias in that because, of course,
Absolutely.
you're not going to go and talk to a financial advisor about investing in a property and growing your property portfolio unless you think unless you feel good about the future prospects of the market. So, often when we're talking to people who are bullish because they're here talking to us about growing their portfolio.
That's right, yeah.
Now, if I compare that, so our magazine, the New Zealand Property Investor Magazine, is the official mag for the Property Investors Federation. And we were meeting with them only a couple of weeks ago. And they have a slightly different cohort or group of investors that they work with. Often they're a little bit older, have been in the market for a longer time. Some of their investors are pulling back because they might have been investing for 20 years. They're now 60 years old. They're like, I want to retire. And you know what? I don't like the new taxes. It's way harder to get a mortgage today. The tenancy regulation has become a lot stricter, and there's probably 5 or 6 different things that have really made it harder to be a property investor. And for those guys who have already made their money, they're thinking, you know what, I'm out. Let me sell up now.
Rotate into commercial property investment, if
Yeah.
anything.
Yeah, or a lot of them are interested in shares or funds or finding some way to just retire. Now, those people will start withdrawing and selling those properties. I suppose for a lot of the people that we get to work with every day, they're at the start of their wealth creation journey. So if you haven't made your money yet, you're still looking for the way that you are going to make your money so that you can eventually, in 30 years' time, say, bugger it, it's too hard, I'm selling my assets, and I'm just going to live a comfortable lifestyle.
Yeah.
Yeah.
And you got business and you got property. You have other options, of course, but
Well-
those are the 2 ones that most people actually do well with in New Zealand, right? Business and property.
The only way,
Darcy, talk dirty to me.
yeah, the only way that you can really get
Button
ahead.
up your shirt there, Ed. Come on.
You can't save yourself rich, or even if you could, if you earned really high income, it would be just such an inefficient use of your money. So you have to use leverage, and you leverage either through using the bank's money, or you leverage through people, through business. Now, I do both. I have a business and I have property investment. I can tell you which one's a damn sight easier. So even if I complain that interest rates are high and taxes are a pain in the butt, my property portfolio gives me far less grief than our 80 staff.
That's true. And of course, you can make money in shares, and absolutely people should be investing in a range of different assets, right? But we're specifically here talking about property today. And I think that it is one of the asset classes that are most accessible to New Zealanders. So often other economists will come out, and in fact I'm debating one of them in a couple of months' time.
I can't wait for
Who's
this.
that? Do you mind me asking?
Brad Olson from Infometrics.
He's coming for you, Brad.
No.
Yo, well, hang on. You were talking last
Go,
night
Brad.
saying that you were going to take him out the back and beat him up.
I did not say these such things. But one of the things that I often see some commentators come out and say is we shouldn't be investing in properties, we should be investing in shares. And if you didn't buy that $500,000 property and instead put your $100,000 deposit into shares, you'd do X, Y, Z. But here's the thing, most people do not have $120,000 to put in shares. The way you get your deposit for your investment property is you borrow it against your own home. And the likelihood that the bank is going to let you rock up, borrow against your home so you can go invest in shares these days is very low because banks have very tight lending criteria and are going to interrogate what you're going to do with the money as part of their bank responsibility. And so it is a false versus or a false comparison to say that people shouldn't invest in property, they should take that money and invest in shares. What money? You can't borrow against your house to invest in shares a lot of the time. It's a false comparison.
Right.
Also, I think that most people are a little bit nervous investing in property. They're going to be a lot more nervous investing in something as volatile as shares. And what will happen is, they'll put their money in something and then they'll panic, get spooked when something like COVID hits, and they'll take their money out and crystallise losses. That's not a great way of investing either.
Got it. No, that's good. Okay. Any more gut feel on what you think's going to happen then in the next 12 to 24 months, let's say? Again, putting the data aside, what do you feel is going to happen?
Well, we're coming up to an election, so the housing market will go pretty quiet for the 3 months leading up to that, and probably a couple of months after that, while people kind of adjust to either the new norm or what we've got, and maybe the changes that happen after that. So there are a few people sort of that will sit on their hands over that election time. I still think that there's great opportunities right now, and I'm of the opinion, if the bank will give you the money, invest it. It's dead money otherwise.
I think the other thing that we're going to see is the housing market somewhere between the next 3 and up to 12, maybe 15 months, it's eventually going to recover. We're going to see the turn, and it always depends on the data set, because there are 3 main data sets in New Zealand. One of them is very responsive, the Rhines HPI, and 2 of the others are less responsive. So I'll give you a really interesting example. I read an article maybe 2 days ago that said housing market accelerates. House prices are falling faster. And I read it and I said, well, I wonder what data it is. It's the QV index. And I said, how fascinating that the Rhines index showed that property prices increased last month by a very small percentage, minuscule, 0.1%. But if I look at the rolling 3-month average of the Rhines data set, it shows that this property market falls are slowing down. If you look at another data set that is less responsive, it shows that it's speeding up. Well, why is that? Because it's reporting data really from 2 or 3 months ago. So that's where property investors and anybody reading stuff in the Herald will often get confused, because one article will be quoting the Rhines data and say, house prices went up by, of course, a minuscule 0.1%, and then the next week, house prices fall faster than they have been.
So they're quoting different data sets.
Different data. Well, of course, because they just get the press releases from QV or CoreLogic or Rhines, and reporters are doing what they should do. They're reporting what they're getting. But because there's 3 different data sets, you will often get conflicting articles. Now, stuff's not there to be your financial advisor, and that's why I suggest don't get your financial advice from a journalist or from a news organisation. You've got to, listen to a podcast like this, perhaps the Property Academy podcast, but talking to a financial advisor so you can help wade through the conflicting articles that you are reading online.
Or just wait 6 months.
That's right. So this is one of those few moments where, hey, maybe waiting 6 months is a good idea, right? Like wait for the election. Right?
Absolutely,
maybe.
bloody
No way.
You need to think counter-cyclically, though, Darcy. If people aren't buying, that's when you want to buy.
Absolutely.
Because there is more choice on the market these days. There are twice the number of listings than there were about 12 to 18 months ago. So there is more choice available. If you're investing in the new build space where there are significant tax and deposit incentives, then developers are being extremely accommodating at the moment, because inquiry for new builds for some developers is down about 60%. And so that is meaning that there is opportunity there. Now, that's not going to hang around forever. As soon as you see house prices increasing, people start coming back into the market, sentiment changing, some of that opportunity is going to go away.
Yes, yeah. I'm glad you mentioned the developer piece, because I've been seeing a few posts on LinkedIn from property developers, and I'm trying to understand what the story is around what's going on in terms of the compression of margins and what risks that puts on developers in terms of going bust or not being able to complete projects, and then what the flow-on effect is to the purchasers who maybe have signed up, they've paid a deposit.
Yep.
What can you tell me about that? Or what could you say to people who have bought off the plans, especially, or people that are thinking about doing it? What kind of due diligence should they do on the developer?
So we've actually got an article on our website where Vanessa, who's our head of compliance, goes through some of the steps that she does before we onboard a developer. So the developer is as important as the property, because if they can't deliver the product, then you've wasted your time. So long as your deposit is held in a lawyer's trust account, you're not going to lose your capital.
Which
the
is
developer goes
that
under.
is the way it works, right?
Well,
Someone pays
it
a
is.
deposit.
It's the way it should work. It's not the way it always works. So I have seen contracts where developers have been receiving and using deposits. That's highly risky. And anyone that's old enough to remember Blue Chip, when they went under, that was how people lost their money.
Yeah.
Nowadays, your money should be in a lawyer's trust account, and if the developer goes under, you get your money back, unless there's a guarantee, like a master bill guarantee, where someone else comes and completes the project on the developer's behalf. Now, there will be developers that go under this year because their margins are so thin, they can't get jobs finished, financiers will be winding them up. We get calls from financiers all the time
Same.
about projects that they are going to wind up those developers on because they've completed the product and they haven't got the sales. That's a real problem, and that's where the opportunity is that Ed was talking about before. So we are seeing some really good deals because developers have to get the pre-sales, even if their margin is 3% or 7%, whereas last year or the year before it might have been 20%. Now, it will only be so long that you get that lower margin because funders want to have a better margin than that. So what I think will happen over the next wee while is you'll see developers get rid of that stock. They'll sit on their hands. They won't be buying land. I know a lot of big developers have not bought land in the last 12 months, and they're going to finish their jobs and then wait for the opportunity to come up where they can buy land at a reasonable price. Now, what will happen is there won't be as many options next year as there are this year because some developers will go, other developers will stay in the market, but they won't be buying land. So then all of a sudden you've got a supply issue, and that will help push prices up.
Yeah, welcome back to the free market, right?
Yep.
So natural forces will cause a restriction in supply, like what you just described, which will probably assist with that underpinning of the floor of the price movements downward, right? But there's delays and distortions and all the rest of it. And it takes a while for developers to do what you just said.
Yeah, well, there are developers that are on the ropes right now that are lasting and have lasted a lot longer than we imagined that they would. But there is blood in the water.
Yeah. What happens to these projects then? So a developer goes bust, it's not completed. Let's say technically another like a master build guarantee kicks in and off you go, but that's not necessarily true.
Well, that's
right?
probably not the case for a lot of projects, but what will happen is the financier will likely have a relationship with another developer. They'll come in, they'll buy it from cents on the dollar, and then they'll finish the project and deliver the product to someone else. And those contracts may or may not remain in play. They might cancel those contracts and sell them again, particularly if they can get more money.
So we're likely going to see a bit of a flush out of these developers that haven't been able to run an efficient business or
have overexposed. So I think one of the big ones, I think they're just a bit late in realising that the market had petered off and they were still buying land, still trying to sell things at really high prices. Now they're left with a lot of finished stock. That's going to be a problem. And the developers that have had a lot of their funds, so they've taken funds from the public, from wholesale investors, they will be under pressure.
Yeah, you can already see a couple of train wrecks coming. There has been some fantastic reporting in both Business Desk and the NBR about Duval, who have taken a lot of funds from investors and have made some large changes where they're no longer paying the 10% returns that were advertised and are doing all sorts of things. Now, it was very interesting that FMA, the Financial Markets Authority that governs investments, came out and said that some of their advertising or statements to investors had been misleading because they'd suspended the cash distribution but didn't tell the investors the reason why, which was that they couldn't pay the distribution and also meet their other commitments. Now, Business Desk asked them, what do you mean by that? And the FMA said, you can draw your own conclusions, which effectively means they didn't have the money to pay the investors and also pay everything else that they needed to, so they're tight on cash, or likely tight on cash, is my read of that specific situation. I think that is probably the slowest train wreck in history, and I think that it is going to be a large train wreck in my view. And so we've been active warning people that that's probably going to be the case, in my view.
And I guess you have to be a little bit careful with how you do that, but when it's publicly available information, the job's a lot easier, isn't it?
Well, Business Desk and NBR have been doing an excellent job on that, and I think the FMA is doing a wonderful job reporting some of those misleading statements and making sure that investors, insofar as they can, given that there is far less regulation around wholesale investors, but trying to make sure they're doing their best to do best by investors.
Yeah. Do you see a lot of other contagion risks from developers going bust?
Yeah, absolutely. So people will be more nervous about buying off plans, but also, let's say Duval goes under and people lose money in that fund. What does that mean then for the person that's got money in Williams Corporation or Wolfbrook, who might be perfectly fine, but now they want to take their money out?
It's basically a bank run risk,
isn't
it? Which we've seen obviously overseas recently with the big old 3S's, SVB, Silvergate, and the other one, I can never remember, Signature. But I guess it's the same sort of concept, right? People might have money invested with these other developers. They get nervous because what they've seen with Duval, they want to pull their money out, and now other developers that didn't have a problem probably do have a problem, right?
And not only that, a 10% return was 10 times the interest rate that you were getting in the bank. So that was pretty attractive for people when they were wanting to actually get a decent return from their capital. Now you can get 4 or 5% in the bank, so that's your no risk rate of return. So am I willing to have something in a high risk fund when I can get half of that in the bank with no risk? Probably not.
Well, these days the bank is giving a high return if the distributions aren't being paid, of course.
Yeah, that's true.
Slight detail. We talked about debt to income ratios already. Let's just talk a little bit about any sort of other risks that a recession is kind of like one of the most anticipated recessions ever, isn't it? Like it seems so strange, isn't it? Like I understand the economics perception around why there's a recession coming and why we might already be in it, but it's not necessarily true to say that we can engineer a recession and therefore predict when it's going to arrive, endure it, and then plan for the escape. It's not really that simple, right? It's got to be more of a monetary phenomenon, in my view. What are your views, though? Like, in terms of the recession, how long do you think it will last? How bad will it get? What's your view?
My view is that the bark is likely to be worse than the bite. So if you look at what happened to New Zealand's GDP over the last quarter, ended in December, end of last year, the economy shrank by 0.6% that quarter. Now, that sounds really bad until you think that the quarter before that, the economy grew by 1.7%, I think it was. I think the quarter before that, it grew by 1.3%. So if you think about, well, how far back are we rewinding the clock? And it's like, okay, so we're still better off than we were 9 months ago. Well, what was it like 9 months ago? Well, the economy wasn't that bad. I wasn't out on the street, with a can shaking for dollars. I was still in a job, and most people were. And so I think people get very scared whenever you see a decrease in the size of the economy because they think, oh, that's really bad. But we're talking about a really small amount. And if I just put it in these terms, if you think about your job, if you had a 0.6% pay cut, would that be the end of the world? And for most people, the answer is no. Now, the issue with recessions, though, is that the pain is not evenly distributed. So when I say think about your income and take off 0.6%, it's not like that at all, because for some people, take off 100% of your income, and for others, take off none of your income, and for others, take your income and add 3 or 4%. Because there are some people, I gave one of my employees the other day a 10% pay rise because inflation, because he's doing a good job, for a whole heap of reasons. So there will be some people who lose their jobs, there will be some people who have no change in income, and there will be some people who have a large increase in income, whether because they're progressing through their careers and taking on a role with more responsibilities, or because they're doing a good job, or inflation, or a range of different reasons. And I think what people think is they see recession and they think lots of job losses. There will be potentially some job losses, there will be some job losses, and we see some firms cutting back on staff already. But that pain will be concentrated among a few people. It won't be across everybody. Not about I think when I ran the numbers, at peak unemployment, according to the Reserve Bank's forecast, it's about 5 point something. So 94% of people who want a job will still have a job.
Yeah. The other thing I'd say to that is I know that this feels like scary times for a lot of people, particularly because the media, like Ed said before, they produce these wonderful headlines that get clicks.
They don't even have to consult ChatGPT.
Maybe they should. But nothing in investment is certain. But you can have a certain outcome of doing nothing. And if the outcome of doing nothing isn't going to get you to where you need to be or want to be, you have to make some change. And there will be recessions, there will be government changes, there will be tighter regulation, there will be higher interest rates, there will be price drops, all at some stage. But you need to do something, and if you have to do something, then, okay, what's it going to be? It doesn't have to be property, but you do have to make a decision to make change if you want a different outcome.
And that's probably a really good place to maybe bring it to a landing here, is because I think there's a lot of reason why you could sit still and kick the can further down the road for 6 months and always find a reason for that. But if you're in a position to act, if the bank's going to give you money, and if you already had a pre-existing plan or strategy which involved the purchase of property or some other investments, this is just part of the environment that we're going to see, like what you said, Ed, like 3 or 4 times more between now and we retire, if you're in your 30s, that's probably par for course. If you can't handle it now, it's not going to get easier next time you see the next correction, right?
That's right.
So in other words, what you're saying is that, hey, maybe it's a little bit overblown, this whole recession talk. That's kind of what you're saying, right?
It depends who you're talking about. For the person who loses their job, it's sort of overblown.
Yeah.
For most people, though, it will not impact them at all and won't notice it.
But that's the issue, right? Like, most people in that pyramid, most people are taking their advice from stuff still, or traditional mainstream media, which forces them to act based on that. They feel almost obliged to act to that blend of all that stuff in there, which is negative. They feel like they have to react to that. Whereas those that think differently, that do get the different results, they actually think differently. It comes back to how you think, doesn't it?
Yeah. And if I can tell just one story before we wrap up, a lot of this is about saying, hey, look, you should grow your wealth and invest in assets. And I want to tell you the reason why. We recently had a couple come in, and we have about, somewhere between 35 and 40 couples come in every single week to talk about their portfolios or start their journey. And we recently had a couple who were in their 60s who came in and said, hey, we're starting to think about retirement. We've got our KiwiSaver, we've got our house, but we don't have anything else. How can we use property to grow our wealth for retirement? And the honest answer is, you probably can't, because it's too late. The bank is not going to give you a mortgage to go out and buy an investment property. Now, if you had a lot of money, we might be able to buy an investment property and you can live off the rental income. But at some point, it is actually too late to start preparing for your retirement. And I know that's a terrible thing to say, because of course it's never too late to start preparing. But the question is, how prepared are you going to be for retirement? I mean, you can be one day away from retirement and start preparing. That's not too late to start preparing, but you aren't going to be prepared.